What is going on, traders? We are going to take a quick look at our trades the past few days. We've been trading NVAX quite a bit. We didn't really make too much, just 140 bucks on it today, but overall the past few days we're up $1,300. And watching it for the price action on it today is really hard to measure and kind of calculate what might happen. So we've just been kind of sitting there and watching it for most of the day. Haven't really done much. But we're also going to talk about stop losses real fast and why I don't really use stop losses anymore. Obviously, I still have to close trades when I have to, and I'll show you an example of that. And I'll also show you a couple examples of why stops most of the time don't work out in your favor. So let's go ahead and get into it here. You can see, let's just look at entry points real quick. So look at our entry here at the $154 level a few days ago on NVAX. You can see we basically bought it almost to the penny on the low for the day, and it took off from there. Now, we could have bought this, here, closer to market open. We could have bought it here when it started to, we could have bought it up here when it started to show more confirmation. We could have bought it here when it started to show confirmation above our center VWAP. There's so many reasons why we didn't do that, but there are also so many reasons why we bought it at this price point instead. And the idea with trying to avoid having to set stops is to get the best entry possible and to put all the work in ahead of time to make sure that your entry is so good that if this trade doesn't go your way, you have a high likelihood of it resetting and being able to break even, or you have a high likelihood of being able to stomach some volatility in the short term and have a reset and have the stock play out the way that you expected it to. And so let's look at an exact example of that. So going into the next day here on NVAX, you can see we opened a short position here, and if we had put a stop loss here above where our first entry for the short was, we would have locked in a red trade. But instead, we were adding to our short position and adding to our short position, adding to our short position, getting more and more in the red because we were very confident from previous price action, volume, pressure points, and previous price action, retracement, time of day, all these different factors. We're very confident that we are going to test this resistance that we were getting close to and have a sell-off. Sure enough, we did. We were patient. We were able to stomach some volatility. We were able to stomach some red because we were very confident in our entry point, just like we were the previous day. And this, sure enough, ended up selling off. And this was a good trade. This was over $1,000. Now let's look at the opposite of what happened. Later in that trading session, we took another short position for $100, which was only 1/3 the size of our initial short position in order to hedge our original profits in case the stock didn't go our way. That way, if the stock didn't go our way, because this was a much more risky trade than this was right here, if it didn't go our way, we would still be green on the day and we wouldn't have lost most of our profits. So we took a smaller position size. Right around this entry point was a catalyst that came out on it. And you can see all this volume that started to come in out of nowhere and really started pushing the stock up fast. Since we were in a short position, we started losing money here and we cut our losses. Now, this wasn't a stop. I just closed the position out because of what the information was telling me. Breaking resistance, volume picking up, catalyst coming out, stock not going our way, resistance not being respected, and therefore had to dip out of the trade and lost some of our original profits yesterday. And since then, you can see that having closed our trade, we would have been much more in the red if we didn't. And going into our trading session today, you could see we had a new pre-market high. We would have been very in the red at this point because, like I said, this was a short position. This wasn't a buy here. And we had no open position during all of this. You can see market opened. We dipped down almost to the same exact dollar, 187.50, bounced off that same exact zone yesterday, and then took off. This bounce happened because this was the initial dollar amount where the catalyst happened the day before. And so that would have been a great buying opportunity there. But we weren't watching that. We were watching Bed Bath & Beyond this morning and Activision. So we didn't really catch this, but you can see here also, we were so patient today. And as you can see from the past 3 days, our entries were so confident the day before. Entries here almost at the bottom low for the day. Short position here, right before the sell-off happened. Entry here, literally almost at the high for the day at 199.46. Didn't go any higher. Had our sell-off here. There was so much retracement and work and patience and attention that went into making sure we got the best entries possible, so that we could stomach some short-term volatility if we had to, and so that if the trade didn't go our way, we at least had a high likelihood of it resetting to the significant entries and breaking even. There are so many times when you set a stop loss as a new trader. This is what I used to do. I used to jump into a trade, set a stop loss, and a lot of times it was very close to my entry point, and the market would jump down and fill that order in the blink of an eye and then take off without me. And that's when you have orders that are just sitting there very close to price action. That happens a lot when large orders come in. It'll buy up as many of the shares that are around the price action that it can, and then take off and move without you, and you lose those opportunities. Let's see if we can find an example. So let's say yesterday we were trading this. Let's say we wanted to buy this dip opportunity, and we ended up buying right here at our center VWAP. Now, a beginner trader would see this and say, okay, we're about to hit our center VWAP. We've been bullish coming into this. This is an opportunity for a bounce. And then what they do is they enter the trade right here when we meet our center VWAP, and then they set their stop loss down here in case the VWAP is not respected. And you can see this candlestick probably happened literally in the blink of an eye, filled numerous stop orders, and then this stock ended up taking off without that buyer. And what should have happened is that this trader should have respected the price action, the volume, what was happening historically in the price action during the day and the day before, and just respected this zone and stomached the volatility, because you can tell this day trader who would have jumped in at the center VWAP here, at the end of the day, they were right. The stock did bounce. At the end of the day, they were correct, and they could have made some money off of being patient, waiting for that bounce opportunity. But if they had a stop there, the market would have filled them and left without them. That happened to me so many times when I first started day trading. So many times, it was so frustrating. And eventually it forced me to get much more picky with my entry points. And I always am always shooting for entry points now that if they don't go my way, I have a high likelihood of the stock at least testing the zone again to break even, or I have a high likelihood of just stomaching some short-term volatility for a while and the stock eventually working out in my favor. As you can see right here, we started a short position, stomached some red, added to our short position, stomached more red, added to our short position, and eventually the trade worked out in our favor. And never even thought about using a stop right here, because we were very confident in the story that the price action, retracement, and volume and pressure points was telling us. And so that's why it's so important to have so much confidence in your retracement that you have a high likelihood of things going your way. You can even see here that we took a short on this almost on the high for the day. Fantastic entry point, and ended up just not feeling comfortable with it, just wasn't vibing with it, so we closed it out quick. But you can see that would have played out pretty nice. One last example of this: a few days ago we traded Shift 4 payments. This is going to be super helpful for you guys, so try to catch this. All right, so Shift 4 payments opened up. This is on the 29th. We took this trade. This was a $1,000 trade, 500 shares at 61.47. Now, if we put a stop on this, you can see here we very likely would have lost money, because this ended up selling off and did not stop for, how long is that? Like half an hour almost. And as a new trader, you would see this looking like a confident sell-off and closing out your position and taking the loss. Well, I didn't even think about using a stop there because I had so much confidence in the entry point. The reason is, if we go to the day before, let's pull up a 20-minute. Okay, yeah, here we go. All right, so let's look at the day before. You can see we met long-term support here. Long-term support retracement, and the market respected it. This is a ton of volume for this stock. So we got really volatile here in the price action. You can see that we're having a hard sell-off, and we started to have a wash between the bulls and the bears, and a lot of volume came in, and we respected and bounced off of this long-term support. Through all that volatility, we bounced off of these key levels here at $61. And with having all the volume behind our support and having a very low likelihood of testing this support again, because this was a ton of volume and it bounced hard off of that, we wanted to trade the significant price points for the previous day, which was $61. So the market opened up. We waited an hour and a half to get that entry, and we were able to stomach some short-term volatility, and eventually the stock played out in our favor. Basically, this almost the same exact dynamics of NVAX that we just looked at a minute ago. And you can see that we sold right at our top for the day the other day, which was our close yesterday, consolidation and closing price the day before. And then after that, stock really didn't do very much. So if we were using stop losses here, we would have locked in the red. And that's why I don't really use them anymore. My mindset is always to be insanely patient and picky on an entry point where the story of price action and volume and pressure points is telling me is going to be safe and have a high likelihood of working out well. And I'll watch it. If it's not going the way I expect, then I'll just cut losses myself. I don't have to worry about having a stop set. I'll just cut the losses myself, which you can see in that other quick example that we had to do on NVAX when that catalyst came out yesterday. So overall, we're averaging over $500 a day this week, so things are going pretty well. I'm watching Activision very closely. I want to see Activision break below $68, and I also want to see Bed Bath & Beyond break below $18 and look for volume opportunities and order flow. Look for a nice bounce opportunity to be able to snag a good profit on those. So that's what I'm watching today. But yeah, I hope this video was helpful for you. If you liked it, if you want to see more videos like this of regular tips and tricks just to help us all become a little bit sharper every single day as day traders, please consider subscribing to the channel, and I look forward to seeing you in the next one. Take care.